The valuation of currency forward contracts is a fundamental component of international finance and foreign exchange risk management. At contract initiation, a forward agreement typically has zero value because the agreed forward rate is consistent with prevailing market conditions. However, as exchange rates and interest rates change over time, the value of the contract fluctuates. The mark-to-market (MTM) value represents the current economic value of the forward position before maturity. Determining this value is important for portfolio managers, corporations, and financial institutions because it measures unrealized gains or losses and helps assess exposure to currency risk. To calculate the mark-to-market value of a forward contract, analysts compare the original forward rate with the current forward rate for a contract having the same remaining maturity. The difference between these rates is multiplied by the contract size and then discounted using the appropriate interest rate for the price currency over the remaining life of the contract. When valuing a position, the analyst must determine the rate at which the position can be unwound. This requires careful selection of the appropriate bid or ask quote, depending on whether the contract holder would be buying or selling the underlying currency to close the position. A gain occurs when market movements make the original contractual exchange rate more favorable than the current forward rate available in the market. Conversely, a loss occurs when the market moves against the holder's position. For example, an investor holding a long forward position in a currency benefits when that currency appreciates relative to the price currency. The mark-to-market value therefore reflects the economic advantage or disadvantage embedded within the contract at a specific point in time. Accurate valuation is essential for financial reporting, performance measurement, risk management, and determining whether a position should be maintained or closed prior to maturity. Parity conditions form the theoretical foundation of currency valuation and forward pricing. Covered interest rate parity, CIRP, states that forward exchange rates must adjust to reflect interest rate differentials between two countries. If CIRP holds, investors cannot earn riskless arbitrage profits by borrowing in one currency, converting funds into another currency, investing abroad, and simultaneously locking in the future exchange rate through a forward contract. The forward premium or discount on a currency is therefore determined by the relative interest rates of the two countries. In efficient markets, arbitrage activity ensures that covered interest rate parity remains closely aligned with observed market prices. Additional parity relationships provide important insights into exchange rate behavior and international capital markets. Uncovered interest rate parity suggests that currencies with higher interest rates are expected to depreciate over time. Purchasing power parity links exchange rate movements to inflation differentials between countries, while the international Fisher relation connects nominal interest rates, expected inflation, and real interest rates. Together, these parity conditions establish a framework for understanding currency valuation, forecasting exchange rate movements, and assessing international investment opportunities. For CFA candidates, mastery of mark-to-market valuation and parity conditions is essential because these concepts underpin foreign exchange pricing, risk management, and global portfolio decision-making.